In times of uncertainty, people follow the ones who bring clarity. Hi, this is Robbie Thomas with Realty Experts, your Bay Area downsizer, bringing you the August 2024 market update. Although the updates, the bulk of it is general towards the whole of the market itself, the real estate market nationwide, you will find the local market stats at the end of this video. If you want to skip and go to the end, please go to the end. Thank you. Let's look at the mortgage rates drop. So the mortgage rates dropped, and the decision was by the Fed on July 31st, 2024. In support of its goals, they said that the committee decided to maintain the target range for the federal funds rate at 5.25 to 5.5%. The Federal Reserve struck to script holding monetary policy unchanged, but strongly suggested a rate cut is likely in September. The inflation data must cooperate for the Fed to follow through, but all indicators are that it will. Global investors are cheered by this. Stocks are up a lot and bond yields are down as they should be. The economy is set to soft land, says Mark Zandi from Moody's Analytics. Mortgage rates declined to their lowest level since early February. Expectations of a Fed rate cut coupled with signs of cooling inflation bode well for the market, but appreciation in consumer confidence may prevent an immediate uptick as affordability challenges remain top of mind. Despite this, a recent moderation in home price growth and increases in housing inventory are a welcoming sign for potential home buyers, says Sam Carter from Freddie Mac. The unemployment rate rose by 0.2 percent point to 4.3% in July, and the number of unemployed people increased by 352,000 to 7.2 million. These measures are higher than a year earlier when the jobless rate was 3.5%, and the number of unemployed people was 5.9 million. This is from the US Bureau of Labor Statistics. Now look at the historical chart from 1948 to 2023. This is the baseline. The white dotted line is the baseline. We are currently over here at 4.3% in July, seasonally adjusted. So the unemployment rate rose by zero point 0.2 percentage points to 4.3% in July. Mortgage rates are plunging on the news of weak job growth and rising unemployment, says Lawrence Yun, the chief economist at National Association of Realtors. Let's look at the chart for the mortgage rates dipped to the lowest level since February of 2024. So, right from here, when it peaked over here at 7.52%, this is in May of 2024. It has been steadily going down and then a slight uptick, but still under 7.5 in the middle of June, and then continuing to go lower. And now in the month of August, it's at 6.4 percentage, which is more than 1 point from 7.5 to 6.4, which increases buying power for the buyers. Let's look at that. So let's look at the demand based on the rate environment. So mortgage news daily rate, 30-year fixed rate in 2024 in the month of August shows you that that's what we just saw at 6.4%. When the interest rate goes up over here, the purchase power goes down. So it shows when the numbers go up here, when the percentage goes up here, it shows it's weak because the buyer pool reduces and the buyers who are qualified reduces, and their motivation to buy at these elevated home prices are less. So when the interest rates dips, and especially if you go to the light green and the darker green area, where which it was historically for the last 4 years or 3 years rather prior to this year, um, the interest in buying was very strong. But now we have entered this good area, which is like buyers are still contemplating buying, and they are buying, although not in droves like before. Still, in some properties, multiple offers are coming in, and in some cases, just one offer. But the home is still selling, even though it's sitting on the market a little while. This is what that chart means. Now let's look at the drop in mortgage rates and what it could afford and can afford. As of April 24, and now the loan amount, let's say, was 500,000. Mortgage rate at 7.52 in April 25th, 2024. The monthly payment was 3,502 and 92 cents. But keep in mind, this is not calculating the the insurance, the other insurance, the HOA dues, if there's any other fees involved in it, because every area there's mellow rules. None of that is taken into account. It's just the basic principal and interest payment over the April 24 interest rate and the current, which is August 2024. Okay, so for the same 500,000, mortgage rates at 7.52 used to be 3,502 and 92 cents per month, and now it is 3,127 and 53 cents per month. So the difference in monthly payment between these two is 375 and 39 cents. And the difference over the life of the loan, which is, let's say it's a 30, yeah, it is a 30-year calculation, 30-year fixed loan. The difference in calculation because of this lower payment is about 135,000, 140 and 40 cents, which is significant. But um, still, buyers want to go, waiting for even lower interest rates, which I personally think may not happen, but let's see. There is a large pent up stored demand that could be released into the marketplace when conditions improve, lower mortgage rates, and more inventory. Inventory is finally turning up about 15%, and that likely is an early leading indicator that we may finally see more home sales as conditions improve, says Lawrence Yun, the chief economist at National Association of Realtors. Listings have trended generally upward of late, suggesting to us that a rising number of current homeowners can no longer put off moving, says Doug Duncan, Senior VP and Chief Economist at Fannie Mae. The hopes of lower interest rates need the reality check that lower doesn't mean we're going back to 3% mortgage rates. Mortgage rates are 7% now, and best we may be able to hope for over the next year is 5.5 to 6%, says Greg McBride, Chief Financial Analyst at Bankrate. Goldman says we now expect consecutive 25 basis points rate cuts in September, November, and December. The slowdown in job growth in the July report likely overstates the decline in the underlying trend. But if the August employment report is also weak, then a 50 basis point cut would become likely, says Bill McBride from Calculated Risk. Home prices. Let's look at the home prices now. Expert forecasts lean towards a moderation in home price growth over the next 5 years. This translates to a slower and more sustainable pace of appreciation compared to the breakneck speed witnessed in recent years, rather than a free fall in prices, says Norada Real Estate Investments. In 2024, the 24 home price forecasts depreciation as of 8/5, that's August 5th, 2024, is average of all seven is 3.1% depreciation, appreciation, and depreciation. 6.1 by Fannie Mae, 4.5 by MBA, HPA says 4.3, Goldman Sachs says 3.8, National Association of Realtors says 1.6, Zillow says 0.9%, and Freddie Mac says zero point 0.5. In 2025, the home price forecast percentage appreciation depreciation as of 8/5/2024 says average of all is 2.7. Goldman Sachs says 4.4, Wells Fargo is 4.3, MBA says 3.3, HPA says 3.2, Morgan Stanley says 3, Fannie Mae says 3, Zelman and Associates says 2.3, Freddie Mac says zero point 0.5, and Moody says zero point 0.3. Even if the average national home price forecast for 2025 is correct, it's possible that some regional housing markets could see mild home price declines, while some markets could see elevated appreciation. That has been, after all, the case this year, says Lance Lambert, co founder of Resi Club. This is true because it depends on the condition of property, depends on certain zip codes, it depends on proximity to work or school, can be a various number of reasons. So even though it has been a declining market, there are some properties which I have seen have gone on multiple bids and hundreds of thousands over asking. While house affordability is low for potential first time home buyers, slowing price appreciation and lower mortgage rates could help. So the dream of home ownership isn't boarded up just yet, Odetta Kushi says from the deputy chief economist at First American. Let's look at the equity and capital gains. Home value, equity, and debt. These are the three comparisons where the blue stands for the home or the owner's equity since they bought it. Home mortgage liability is how much they owe the banks, and the real estate value is what the value of the house potentially could be at some point of sale. So 13.1 trillion is the national home mortgage liability. Now, two and a half times of that approximately is the homeowner's equity, which is already built in, and the real estate value of that could be 45.8 trillion, which is almost four times the value of the home mortgage liability. This is one of the reasons why when some people say like the market is going to crash, well, it could correct, but about a crash, I mean, unless everybody sells en masse and there is a foreclosure crisis of sorts, a major job loss crisis of sorts. I don't see that happening because there's so much equity and there's so much real estate value built in already. Could take some time to correct, which is why those moderate estimates in the earlier chart showed between 3 to 5 years of steady decline. Now, in closing, before I show you the final chart, um, this is the Bayarea Downsizer. You can find me on YouTube at Bayarea Downsizer. If you search for me on YouTube, you can subscribe and like if you like my content. I bring you up to date information. And if you like a free consultation, just copy this link and book an appointment for a free consultation. And we could take it further from there. And if you need anything at all, just call me directly at 510-374-2264. Now, on to the final bit of the updates, which is over here. This shows you the real estate supply and demand. So, what is active as of August 23rd, 2025? I've taken a small sliver of the Bay Area, predominantly the East Bay, but I can do it for any city if you'd like. This is direct raw data from the MLS. I have to compile it and then send it as an email to you. So if you'd like it, you could just go to my YouTube channel and subscribe, and then I'll get your email and I could send you the update on a weekly basis. This shows you the current as of 23rd, 12:51 p.m. because this is constantly, this is dynamic, so it's never the same, but it varies little by little. Supply and demand, because what's active is what is the supply, and demand is what is pending because now it's out, it's in escrow, and no one else can write an offer it unless it comes back on market, which becomes active again. So this is supply for single family homes. This is supply for condos and townhomes. This is demand for condos and townhomes, and this is demand for single family homes, duets, and anything with a patio or detached. So let's proceed. So if you look at Fremont, which has got five zip codes, single family homes have got 104 supply and pending of 64, which is almost like 80% and 85% higher than demand, which is a rare thing. I have not seen these numbers because it used to be the reverse. It was to be inverse over here for the last 8, 9 years. And off late, this is happening since last month, where I see there's more supply and less demand. This is including all five zip codes, any property, any square footage, any condition. And the same thing applies here in condos and townhomes. You see there's more supply and less demand. Let's go to Newark. You have more supply and less demand for condos, more supply and less demand for single family homes. Union City, same thing. More supply for single family homes, less demand. Same thing for Castro Valley. More supply, less demand. Hayward, more supply, less demand. San Leandro, more supply, less demand. San Lorenzo, less supply, more demand. Oakland, more supply, less demand. Sunol is more supply, less demand. Pleasanton is more supply, less demand. Livermore is more supply, less demand. Dublin is slightly more supply, but still good demand. San Ramon is slightly more supply than Dublin and less demand. Danville is more supply and less demand. Why I brought it up and making it sound kind of redundant is because um, if you were thinking of, if you're a buyer or a seller, you should look at the market and see what is happening. If there's more supply and you have more competition at that point, if you're a seller, and if you're a buyer, you have more negotiating power, which you can negotiate in terms of price and terms and various other things. We can go into the details on that consultation if you book, and I'll explain to you how you can proceed with that. If you're a seller, you have to have strategic advantages in pricing, marketing, and in also positioning the property to rise above this competing other properties, so that your property sells first, highest, and closes at the right time. So, in closing, let me take you back to my information here. I am the Bay Area Downsizer. You can copy this link and book for a consultation. Robbie Thomas is Realty Experts. Have a wonderful day, a week, a month ahead, and until next time. Bye.